Hi guys, welcome back to the channel. My name is Dave, and today we're talking about strangles and straddles. Strangle, what you want to do to your boss, and straddle, what I did to that poor, unsuspecting homeless man at the park. Wait a second, I'm sorry, that's for my other channel. Please rewind. Let's start over. This is for selling options for income using short strangles and straddles. That was the topic. My bad. I apologize. Probably more appropriate for this channel. So today, this is a strategy that I use a lot. It puts a lot of money in my pocket. And we're going to cover all the topics about it. So if you can put up with me, and that's what you're looking for, please stick around. Whoop. So first off, all homeless people are safe around me. And that controversy. Second of all, this is kind of a, if you're into wheeling options, selling a put till it gets assigned, then selling the call, this is kind of like accelerating that process. It's like the wheel strategy on steroids, right? We're putting it all into one step, selling a put and a call at the same time, and then managing that position. So I'll link my video above about wheeling options if that might help you. So depending on where you are in the process of learning about options, some of this might fly over your head, some of it might just be fine. So watch and learn. I guess that's the whole thing here. I want to show people how the mechanics of this trade work and start getting you to think about how this might work out for you. We've been talking a lot on this channel about different income ETFs and things like that. For me, I like to have some income ETFs. I hand it off to somebody else. They manage it for me. But I do a lot of my options trading myself. So learn from this. If you're in that, you can kind of start picking up little bits of information as you go along that'll help you understand those income ETFs as well. Now, this particular video, again, is about writing options or selling options, right? So in this case, it's going to be short straddles and strangles. Now, there's also long straddles and strangles if you like it from a buying perspective, and the mechanics are the same. You're just the buyer in that case instead of the seller. So all the same kind of concepts would apply. So with all that said, what is a strangle and what is a straddle? So let's start with a short strangle, and we're going to use stock XYZ, which is always conveniently trading at $100 a share in our illustration. So the first thing we want to do is we're going to go out and we're going to sell our put and our call, right? We're going to establish those two legs. So I've got here, we're going to sell to open a call at 105. That's the strike price that I picked for illustration purposes. And I'm going to sell to open a put at 95, okay? So out of the money put and an out of the money call. When we sell these options, we get to collect that premium, right? So down here at the bottom, I got, okay, we collect $200, just a guess, right? For that $105 call and $200 for that $95 put. So altogether, we collected $400. So just getting started here, if you just did this with a put, obviously you're going to have half of that, right? So this is going to allow us to have a wider break even across this whole trade. So if we look at our break even, if you wanted to calculate this, right, the potential for this to get put to us if the stock falls below $95 by that expiration date, which again, I picked 14 days in this case, and I kind of like to shorten it up. It works better for me than going 30 days or so. I like to have kind of a second bite of the apple. We'll talk about that. But as these things roll along, it makes it really easy to adjust that first trade. So I'm going to collect that $400, which makes my break even, right? In case this was going to get it to assign to me at $95 a share, in case I have to buy 100 shares of this. 100 shares at 95 would be 95 times 100 or 9,500 bucks. But I collected 400, right? So I deduct that from there and I get 9,100. So on a per share basis, that's $91 per share. Down here at the bottom, you can also look at it on a per share basis and say 95 minus 400 divided by 100 gives you 91. So that's where I get my break even on the bottom. And on the top, it's the exact same thing. Our break even's 109. So we're looking pretty good, right? We've got started here. We've collected $400. And as long as it stays between these strike prices of 105 and 95, we get to keep all of the premium. And as long as it stays between our break evens of 109 and 91, we're going to make some money. So at this point, we've established our trade and we just let time roll. We've got 14 days to see what happens. And if we were to go to sleep right now, wake up at the end of 14 days, we're going to see as this thing ticks along here. Do we test these break-even points of 109 and 91? As long as we stay between there, it's going to be a profitable trade. And we can take all those same ideas from a short strangle and put them right into a short straddle. Nothing changes except for the strike price. To turn a strangle into a straddle, all you have to do is sell your put and your call at the same strike price. Now, I don't really enter into short straddles at the open typically. That's not how I really initiate trades very often. I'm typically going to do a strangle, but sometimes I end up in a straddle. So it's important just to understand what it is, but the nomenclature isn't important, but it's the same idea. So in this case, when we sell to open, we're going to collect a larger premium because it's so close to at the money in this case. So I use $350 as my example. So you collect $700. So even though you're selling at the money, you collect that larger premium, you are narrowing down your ability, right, to stay within those strike prices and make money. So in this case, we're going to have to be between 107 and 93. So our window is narrowed down a little bit. But if we do hit it just right, then obviously we're going to have a lot more premium that we can collect with a short straddle. So let's take that Strangle idea over to Fidelity and set up a trade and see what it might look like. Now I'm picking SPY, SPY, a large S&P 500 index ETF that trades quite often. It's great for these types of trades in my opinion. Not too volatile, not an individual stock. I like it for this type of trade. So with SPY right now at 406.60, I'm going to set up my two legs, sell to open and sell to open. One of each, one's a call, one is a put, all right? And out till September 26th. So today is September 10th. So, and it is on the weekend, but just about 2 weeks out. All right. And with SPY at 406, I picked a 420 strike for the call and a 390 strike for the put. And in both these instances, the delta is around 20. All right. So a 20% chance that the person that is buying these has a chance for this to end up in the money. So feel pretty good about that trade. Now for the 420 strike, I'm going to be able to collect about $160. And for the 390 put here, I'm going to collect about $240. So I'm skewed a little bit towards the put side in this case. Now you can do this as a naked call. You can do it as a covered call. It's really up to you and what you're comfortable with. But between these two, I'm going to collect $398 right now. That's the premium that I'll put in my pocket. So very close to our example. So I have about $400. So we can take that 400 and we can look at our break evens and it'll spell it out right here, right? We're going to add about 400 or 4 points to each side. So we got down to 386 and up to 424 after we make this trade. So that's just an example of what it would look like if you set it up in something like Fidelity, E-Trade, or some other brokerage. And here's an example of a strangle with SPY that I just closed out. Now, I did this after we came off that bear market rally and we started to correct, right? We came back down to about $400 a share and I opened up this trade with SPY at $399. So I sold my two legs and we kind of meandered along here until we're at 406.60 now. So I closed this on Friday. But if we look back, I took a snapshot on Thursday because it hadn't moved anywhere, right? And that was probably the best time for me to close it, but I waited one more day. Either way, I did okay on the trade. But if you look at this, I've got the 412 call and the 380 put, or my two picked strike prices there. So you can see from the call side, I sold that for $237 and I've collected all of it except $76. So if I wanted to close it, if I wanted to buy to close, hit that button, it cost me $76, which means I collected about 68% of the total amount that I could have, right? So pretty good. And then on the put side, that $380 put, I sold that for $228 and I've collected 86% of the premium so far. So if I wanted to buy to close that, it would cost me $32. So overall, I did pretty good. And this is, like I said, as of Thursday. So I finally did close the trade on Friday at the end of the day. Now SPY did rally, so it did cost me a little bit of money by waiting until Friday. So it ended up costing me $165 to close the call and about $12 to close the put. So it ended up costing about $177 in total versus about $110 if I would have closed it the day before. But you can see how finicky they can be when it starts moving towards one of your strike prices. So in this case, a big rally towards my call side cost me a few bucks. So to summarize that particular trade, I collected $465.62 when I sold my two options. Then it cost me $177.71 to close the options, giving me a profit of $287.91 over a 10-day period on something that's trading at $400 a share, about $40,000 it was going to get put to me. So if I annualize that, it was going to give me a return of about 26%. If I did that, every 10 days, that's what my return would be. So a successful trade, not blown away, but a good trade, putting money in my pocket. Now let's keep that $177.71 that it cost me to close that option in place, because we're going to come back to this in a little bit as we start talking about different options that I could have done instead of just closing those out. So based on that one trade, it looks like these things just always work out. We always make money. Well, Obviously, that's not true. There is risk involved with these, and it's one of the reasons that I look for ETFs versus individual stocks. I look for peace and tranquility ahead for the next few weeks while I'm in this type of trade. But let's say it moves quickly towards one of your strike prices. Let's assume that it's going towards your put price, right? So that value of that put option to close it would be pretty expensive, right? It's going to go up in value. Whatever you got out of it, you're probably not going to, whatever you got out of it as far as premium, it's probably going to cost you more to close, right? But on the other hand, the one that you sold, that sold call, will be virtually worthless at this point. So you have lots of different options as this moves along. At that point, you could close out that call. It would be very cheap. You keep all that money that you had, and then you start focusing on that put. At that point, you could roll it out a few more weeks and roll it down. You could also roll both of these options out and down, let's say towards the put price, or if it was to the call side, up towards the call side. And again, collect a larger premium, or more premium, I should say, which is going to, again, increase the width of your break-even points. So let's look at what that might look like. So let's go back to the Strangle that I closed out on Friday. And remember, that cost me $177. Remember I said to remember that number. Because now, if we actually did this all in one step and we closed those out for $177 and I rolled these out, I could collect another $433 as shown here. Okay, so $433 minus the $177 that I cost to close puts an extra $256 of credit in my pocket, or increases my break-evens by $2.50 on either side. So again, in this case, I'm selling to open one call, and I'm not only doing that, but I'm rolling up my strike price from $412 to $416, and I'm still able to generate this extra premium. Now, on the put side, I just rolled it straight out. But altogether, my break-evens have expanded even more. So that's another option that you could do if you start feeling like you're trapped. You could roll these things out even further and continue that process. And I think, with something like SPY, you're going to be in a pretty good position now to proceed forward from this point. Of course, with any options trade, there is risk. So we want to be prepared for that risk. So what is it that I look for when I'm doing these types of trades? Remember, we've collected maybe 4 premiums at this point. Our break-evens are looking better and better. So I tend to do this on things like SPY and QQQ. It's boring stuff. It's well diversified, and I can trade all kinds of expiration dates. That gives me lots of flexibility. So I go out like 2 weeks and I make this trade, and that gives me about a week in. I can close it out, or I can go a little bit further and close it out, or I can go in there, and if it start really moving quickly towards one of my strike prices, I can make an adjustment. I can close one out. I can roll out and up, roll out and down. There's lots of flexibility there. What I don't look for is something erratic, right? I'm not trying to get a big premium because I'm doing it with Tesla, for example, right? Or Tesla across earnings season, or Tesla when Jerome Powell is ready to come out and talk monetary policy. These are things to avoid. I'm looking for a period where not a lot's happening. I'm looking for periods where there's no new tops or bottoms as far as the chart goes. Anything here that can kind of help me and indicate that it's a good time to make this trade. And then I'm going to get in and get out. I'm not going to get too greedy either. If I make 60, 70, 80%, I'm going to jump out of that trade, close it out on a Friday, and not carry it over the weekend. So those are some ideas to look for. All right, so strangles and straddles, I do like this type of trade, especially when I'm not necessarily bullish or bearish and I'm kind of shrugging my shoulders, but I want to activate some money. I might look to do something like a strangle. So if you have any questions on any of this, please ask down below. If you like this type of content, please like and subscribe. And we'll see you next time. Have a great night. Take care. Whoop.